The weak US recovery and growing financial problems in Europe mean the Federal Reserve has extended its monetary stimulus. At their monthly meeting, the US central bank's policymakers said they will renew efforts to bring down borrowing costs by selling short-term government bonds to buy those maturing at a later date. Central banks worldwide are seeking to stimulate their weak economies. With its benchmark interest rate already cut to between 0 and 0.25%, the Fed had little room to maneuver in the face of yet another slowdown.
There is a protracted slowdown in the economy, and it's unmistakable right now, especially with the downward revisions that we saw in the previous numbers, and that they're all going to have to go back and rework their assumptions about a potentially slowdown in the economy coming for the third summer in a row now, as we've seen before.
The Fed says the U.S. economy is expanding moderately, but conceded employment growth has slowed. In May, only 69,000 new jobs were created, the fewest in a year. The bank expressed worries about weaker consumer spending, saying it appears to be rising at a somewhat slower pace than earlier in the year, but said inflation has declined mainly because of lower oil prices.